Hi, my name is Kelly Miller, and it's such a pleasure to be with you all today. Don't mind a thing about being the last team. When I was a competitor in this competition, we went last as well. So it's just a delight to be here with you today. I'm going to let my co-panelists and co-judges introduce themselves, starting with Bill Alexander.
Hi, I'm Bill Alexander. I'm with the Washington, D.C. office of Skadden Arps. I do mostly transactional work. I've been doing it for quite a while. Before I was at Skadden Arps, I was in the IRS's Chief Counsel's office as the Associate Chief Counsel for Corporate Tax. Nice to be with you today. Welcome.
Hello, and I'm Robert Russell. I'm from the law firm of Kostelannis and Fink in Washington, D.C., where I practice tax controversy and tax planning. And in addition to Kelly here, I'm an adjunct professor in a tax LL.M program.
And finally, my name is Kelly Miller again. I'm a partner at Reed Smith. I'm resident in our Washington, D.C. office. My practice involves areas of both controversy and tax planning. As Robert said, I do teach partnership tax at one of the main tax LL.M programs. So it is a delight to be with you today. Thank you so much for participating in this wonderful competition. And for purposes of the simulation that we're going to do, by the way, we're not on time yet, but for purposes of this simulation, we are all going to play roles that we're very comfortable with. So we're going to be the senior partners of the law firm that you're presenting to. And I wanted to let you know that as you're addressing your results and your remarks to us. William Chun, William, give a wave. Thank you, William, is been so gracious to be our timekeeper all afternoon. And so you have 30 minutes from the time that we'll start here in a moment. And William will offer time cues at 5 minutes, 2 minutes, and 1 minute. And if you're sharing a document, and I do know that you have a document, it was shared with us, I believe, in advance of your round, he'll interrupt and give those cues orally to you. Any questions before we begin?
Not for me.
Okay, excellent. I'll let you take yourselves both off of mute if you'd like, and we'll begin our time now. So you may begin.
Good afternoon. I'm Stephanie, and Isaac and I will be explaining the guilty election options, as well as the corporate status filing deadline extension, and answering the client's questions regarding her family's IRA accounts. If at any time there are any questions, please just stop me or Isaac and ask. Turning first to the global intangible low tax income, or GILTI, the answer for the client's question is honestly that it depends. Oh, sorry, those are my dogs.
It's okay, Stephanie. That's all right. I mean,
Sorry,
your dog is apparently
going by right now.
It's fine. Your dog is apparently going to be a great lawyer someday, because he or she also agrees it depends. Do you need to do it? Do you need to do anything? I want to make sure you're comfortable. Have you got the dog? The dog is under control.
Yes, the recycling truck just drove by, so they're just barking at the truck.
No worries. We have clients. You're going to have clients someday like your dog, so it's fine. keep on going. Take a minute if you need to collect yourself, but please keep on going.
So broadly speaking, GILTI is going to be the amount of made by a foreign company less the exceptions and deductions over 10% of that business's depreciable tangible property, which the latter part is called the Qualified Business Asset Investment, or QBAI. With a GILTI election, you have the ability to exclude from that income all of the tax or all of the income that was paid in a jurisdiction that has a tax rate of more than 19%. This election can be retroactive to 2018 at the time. Now, this all sounds good, except for by excluding that income, you're also going to be excluding the depreciable tangible property that underlies that income. So it is really a balancing act between how much income you're excluding and the amount of tangible depreciable property that you're losing. Also weighing into this is going to be how much foreign tax credits you are getting for paying that high tax rate and how that will balance out with the rest of your portfolio. Now I'm going to pass it over to Isaac, who will discuss the specifics for Rose going forward as far as each country's breakdown.
Thank you, Steph. Also, as another preliminary matter, the controlling United States or the controlling domestic shareholders are the ones that are able to choose whether they want to make this election or not. And the controlling domestic shareholders are simply just are simply the 50% or more of those United States shareholders that hold 50% or more of the voting stock in all classes of voting stock. So if you look at page 2 on our handout, if Rose Enterprises owns 50% or more of Rosebud Mediterranean, then Rose Enterprises could make the election unilaterally and bind all United States shareholders to this election. If Rose Enterprises owns less than 50% of Rosebud Mediterranean, the controlled foreign corporation, they would still, in conjunction with any other United States shareholders that would be less than 50% of all the shareholders, they could still make this election for purposes of the United States shareholders. So with that being said, I'd like to turn your attention also to page 3, where we put together this sort of handout or chart to help keep track of all the moving parts and all the different subsidiaries of Rose Enterprises, or excuse me, of Rosebud Mediterranean. So first, the first tested unit that we're going to look at here is Rosebud France. And Rosebud France has a tentative gross tested income of 3.6 million euro. All this really means is that they had 3.6 million euro in revenue for this year. We're going to subtract out the deductible expenses, which for our purposes here is going to be 3.1 million euro, which just equals their operating expenses. And this essentially gives us $500,000 of net profit. We're told that France has a local tax rate equal to 28%. So we're going to multiply 28% times 500,000 euro to get a local tax paid amount of 140,000 euro. To get our tentative tested income, we're going to subtract this 140,000 euro out of the 500,000 net profit. This gives us a tentative tested income for Rosebud France of 360,000 euro. So now to calculate the effective foreign tax rate to see if we qualify for the guilty high tax election threshold, we're going to take, well, first of all, we're going to assume that 1 euro equals $1 US. And if you look at Treas Reg 951 Cap A-2, I believe, the examples there under, they make this same assumption. So we'll just carry that forward for our analysis. So we'll have $140,000 in foreign taxes paid, and we're going to divide that by the sum of 360,000, which is just our tentative tested income, plus $140,000, which is again the foreign taxes paid. When we calculate that out, we have a 28% tax rate or foreign effective tax rate, which is not surprising here, considering that we were told we had a 28% local tax rate from the beginning. So 28% is greater than the guilty threshold. Therefore, if the United States shareholders chose to make this election, we could kick out the Rosebud tentative gross tested income from the guilty inclusion amount that would be passed up to the United States shareholders. So now we're going to turn on to turn to Rosebud Hungary, which gets a little bit more complicated due to withholding taxes. First off, we're going to start like we did with the prior example. We have 1.9 million euro of revenue, which is essentially which will be considered our tentative gross tested income. We're going to subtract out our deductible expenses and get $250,000. This $250,000 profit was passed up to or distributed up to Rosebud Mediterranean. And on that $250,000, a 10% withholding tax was imposed. This 10% withholding tax is equal to 25,000 euro. And if we take, after taking out that or after accounting for that withholding tax, that leaves us with $225,000. $225,000 multiplied by the 9% local tax rate gives us a local tax paid of $20,250. So now we take that after subtracting out both the withholding tax and the local tax paid from our 250,000 original net profit, that leaves us with $204,750,000 as our tentative tested income. So now, same sort of analysis, but it gets a little different here to calculate the effective foreign tax rate. So first, we have $45,250 of taxes paid. And this is just the sum of the local tax plus the withholding tax. We're going to divide that by the sum of 204,750, which is the tentative tested income of Rosebud Hungary. And we're going to add back in that same approximate $45,000 to give us an 18.1% foreign effective tax rate. 18.1% is less than the guilty threshold. So therefore, even though 10 plus 9 equals 19, our foreign effective tax rate is 18.1%, which is less than the guilty threshold. And if the election is made, Rosebud Hungary's tentative gross tested income would not be eligible for to be excluded from the gross income or from the guilty inclusion amount, excuse me. Going forward, the analysis is very much the same as Rosebud France. If you look at Rosebud Luxembourg, it's a very straightforward analysis here. We're told the local tax rate is 5%, and after running through revenue less expenses and getting the foreign taxes, multiplying the net profit times the local tax rate, it comes out to a 5% tax rate, which we're told is the local rate, and 5% is less than the threshold. So Rosebud Luxembourg is also not eligible for the election. Rosebud Prague, similar analysis here, except we come out to 19%. 19% is higher than the guilty threshold. So therefore, if the election is made, Rosebud Prague's tentative gross tested income will be excluded. Rosebud Spain, and the reason this is referred to as Rosebud Spain is that Rosebud Mediterranean and Rosebud Barça are both Spanish entities. And under 951 Cap A-2, there we have what's known as the combination rule, which says when we have controlled foreign corporations or their subsidiaries, here disregarded entities of same foreign countries, we're going to aggregate all of their tax attributes. And so here, all of the tentative gross tested income or the revenue of Rosebud Spain is simply just the aggregate of the revenue of Rosebud Barça and Rosebud Mediterranean. And the same goes throughout. And so after we make these same calculations here, we come to a 25% tax rate or foreign effective tax rate, excuse me, which is equal to the 25% local rate, which we're told about. 25% is greater than the threshold. So therefore, if the election is made, Rosebud Spain gets to be excluded as well from the guilty inclusion amount. So that's a little bit of a mouthful there. But after looking at all of the tax attributes and deciding whether or not to make the election, kind of what Steph referred to earlier is really this depends on whether it depends on whether this election should be made, predominantly on what the effect on QBAI is going to be. And so if the reduction in QBAI, which causes an increase in the guilty inclusion amount, if that results in greater income or a greater guilty inclusion amount, then this election should not be made. And then one thing to know also is that this is an election that once it's made, it applies to all of the subsidiaries, and we can't pick and choose which subsidiaries we want it to apply to.
Thank you, Isaac. I'll jump in with one question here. I know talking to the clients, they're not much of numbers people. So can you just explain, big picture, what the benefit of the election, why you would make it and why you may not want to make it? I heard the QBI point, but what does it do to make it or not make it?
Sure. So thank you for that question. First, I guess as a preliminary matter, just the way that guilty works is that it it essentially passes up foreign income to be included in the United States shareholders' income. And so this election allows us to exclude certain income that is accrued in other countries, that is subject to what's known as high tax, and which is greater than the threshold that Stefanie mentioned earlier. And so really this comes down to whether or not the benefit of kicking out certain countries' income or income accrued in certain countries is greater than the QBAI reduction.
Well, what wouldn't I just get my foreign tax credit if I didn't kick it out?
So if all that's well, I'm sorry, can you actually repeat that question again?
I guess if I include it, if we include it, wouldn't I be able to take the foreign tax credit and I wouldn't be in trouble?
Well, yes. So if it is included, you do get to take advantage of the foreign tax credit paid. Or you get a credit for foreign taxes paid, excuse me. But we would still have to essentially crunch the numbers and do what Stefanie referred to earlier and refer to this as a balancing act to see if the election results in less United States federal income tax or more.
Okay, thank you.
So if there are no more questions as to the guilty portion, I'd like to turn back to Stefanie to talk to you guys about Rose Netherlands.
So for Rose Netherlands, it's going to be the newest member of the Rose family. It was incorporated as a BV in the Netherlands, which is a privately held limited liability corporation there. Because it's not a publicly held limited liability corporation, it is not automatically considered a corporation under tax law or US tax law. Therefore, we have to make the election. This election was made. However, it was filed 77 days after the preferred start date for that corporate status. But thankfully, strangely, in these COVID times, because of COVID and the nationally declared disaster, it has been extended. The filing deadlines have all been extended to July 15th. So if we had filed on July 15th, we could still get our February 15th corporate status start date. So there's no concerns related to whether or not that start date will go into effect.
Hey, Stefanie, I'm going to pause you for a second. So you mentioned that the Netherlands BV, because it's not publicly held, is not considered a corporation. Is that right?
For U.S. tax, it will default to an association rather than a corporation.
Okay. So do you look at any other attributes of a foreign corporation to determine its status? What attributes of this Netherlands BV would you look at? What corporate, are there any other corporate attributes that you would consider to determine what it would be, what its classification would be?
So statutorily, you're kind of automatically in that boat if you, I forget what the first, the Dutch first word is, but it's the publicly held limited liability is specifically listed in the statute as being a corporation. There are other ways to become a corporation, but for the purposes of the question, the form was filed and the election was made.
Did they have to make it, I guess, is my question to you. Like, did they have to make an election?
I didn't research this entirely
Okay.
because the election was actually made. My understanding is that there were attributes that you could argue later, but the cleanest way and the way that I would recommend, because it is the cleanest and least prone to fighting, I guess, would be to make the election if that was what you wanted.
Okay. Okay. Are there any, and then you said, I didn't mean to stop your presentation. You were talking about the COVID Rev Proc that extends the deadline, and they had this extended time. And so what is your conclusion there?
So for the RevProc, for the notice 2020-23 implemented the standing guidance that is in RevProc 2009-41 that lists out all of the things that will be extended in the event of a disaster.
Right.
So the notice was providing the notice that the disaster is happening, therefore we're implementing the RevProc, which the notice provided the extensions, like the quantity of time that was going to be extended for all of the things that were listed in the RevProc from 2009. And one of them specifically listed was the election for corporate status.
Okay. Okay.
What is the effect of having made that election now?
That means that Rose will be considered a corporation for U.S. tax purposes, even though it is a foreign corporation. So it will file in that status rather than just being a pass-through entity.
And can they change their mind?
It is my understanding that they can change their minds going forward, but I believe the intent was to kind of build it into the structure that was going to go forward with GILTI if we were to make that election, as to provide kind of a safer place than Spain.
Okay.
And now I think we're going to turn it over to the IRA questions for the client.
So Wendy asked us about different beneficiaries, different individuals, whether she should appoint them as the beneficiaries of her IRA, and whether or not they can take distributions over their lifetime, or if not, what's the other effects? And so first, Wendy asked us to look into the effect of appointing her husband Jack as the beneficiary of her IRA. So Jack, because he is Wendy's spouse, is considered a eligible designated beneficiary under the code. And because he's an eligible designated beneficiary, he can take down distributions after Wendy's death over the next 10 years. Moving on to her son Davis and her daughter Alex, if Davis is appointed as a beneficiary of the IRA, because he is 20 years old and over the age of majority, which we're just going to assume for our purposes is age 18, he is still subject, or he was subject to what's known as the 10-year rule. And all this says is that he has to take down distributions from the IRA within 10 years after Wendy's death. And I apologize if I misspoke about Jack. I can't remember if I said he was subject to the 10-year rule or the life.
You said that the 10-year rule. Is that something you wanted to?
Yeah, I apologize. I misspoke there because he is a spouse. He is an eligible designated beneficiary, and he can take distributions down over his lifetime. So Davis, over the age of majority, he's subject to the 10-year rule. Now turning to Alex, Alex, who's under the age of majority, can, assuming that Wendy dies before Alex turns age 18, she would be able to essentially take distributions until she's 28, because that would be until she reaches the age of majority plus 10 years. And now if Wendy dies after Alex turns age 18 or after, then Alex is just going to be in the same boat as Davis. So he would be, or she would be, subject to the 10-year rule. Wendy and Jack's friend Ronald, he is age 65, and Wendy is currently age 70, I believe. And because Ronald is not more than 10 years younger than Wendy, he is subject to the life over his lifetime rule. And so if Ronald is appointed as a beneficiary, then he can take down distributions over his lifetime. If Rosebud Inc. is appointed as the beneficiary, because Rosebud Inc. is not a person, or an individual, I should say, and not a certain type of trust. Rosebud Inc., if appointed as the beneficiary, the IRA will be considered as having no beneficiary. And when an IRA has no beneficiary, it's going to pass to the IRA owner's estate on their death. And when it passes to the estate, then the heirs of the estate can take down the distributions over the following 5 years.
Would that be the same rule though? If it's, it says Rosebud Inc. is a small corporation. Would that be the same rule if Rosebud Inc. is just the name of the entity, but it's actually, let's say, an LLC that elected S Corp status?
So my understanding after reading the regs is that the beneficiaries to an IRA have to be an individual or certain types of trusts that are specified in the IRA, or not the IRA, excuse me, in the regulations. And because an S Corp is not either of those, that this would be the same outcome, that it'd be considered as having no beneficiary. But that's definitely something that I could verify or speaking with the client.
Okay.
So obviously, the 5-year rule is the least tax efficient because that's more income to include in any given year. So if Wendy wants her heirs to inherit her IRA, then we should just appoint those heirs as the beneficiaries of the IRA so that they can either be subject to the life over their lifetime rule or the 10-year rule.
From a tax standpoint, which of these choices would be the most efficient?
So again, that sort of depends on, I guess, the age at which Wendy dies and the age of Jack and Ronald too, actually, because if life expectancy is less than 10 years, then it would make more sense to allow someone to inherit the IRA that's subject to the 10-year rule because they have more time to take it over, to take distributions down. The older they get, the lower their life expectancy. And as soon as that is less than 10 years, then it would likely become more tax efficient to appoint someone as beneficiary subject to the 10-year rule.
Thanks.
So moving on to the second issue that Wendy had us look into is she took a distribution from her IRA on April 1st of 2020, and she had turned 70 and a half at the end of 2019. And she wants to know whether the recontribution on June 25th can be considered a rollover. The Secure Act changed the 70 and a half. The old rule used to be that the year after turning 70 and a half was the year that you had to start taking required minimum distributions. However, the Secure Act made this now the year after you turn 72. Further, the CARES Act, which was just recently passed last spring, says that if you are subject to this rule that I just described, or if you fall within that, where it's the year after you turn 70 and a half, but now that the rules changed to at the year after turning 72, you don't have to take distributions. A notice, or generally speaking, a rollover must occur within 60 days. And while she was outside that 60-day time frame, the statute allows the secretary to extend this deadline, which was done in notice 2020-51. This deadline was extended to August 31st, and because her IRA permits rollovers, she can roll this amount back into her IRA and not have to include it in income. One thing that she should note, though, is that because this would be considered a 60-day rollover and not a direct rollover or a trustee to trustee, she would have had taxes withheld on her distribution. So she's going to have to make up that withheld amount when she recontributes this amount back into her IRA. So moving forward onto the third issue that she asked us to look into, her son Davis unfortunately had a reduced hours due to COVID-19, and he wants to know whether the $75,000 loan he took out from his qualified plan exceeded any limits under the code. The short answer is no, it did not. the CARES Act extended, or not extended, increased the amount that a planned loan can be made up to. And it can be either it's the lesser of $100,000 or the accrued balance, or the vested accrued balance in that plan. Davis had $140,000 in his plan. So $100,000 is less than the accrued balance. So therefore he could have taken a loan up to 100 grand. 75 grand is less than 100. So he did not exceed any limits. The last question that Wendy asked us to look into was Davis's husband, Patrick, was not, he did not think that the $75,000 loan would be enough for them to live off of. And so he wants to know whether he can take a distribution from his own qualified plan and what those effects are, those tax effects. Because he is the spouse of someone that has been affected by coronavirus, whether through actually becoming sick or through reduced hours, which is the case here, he can take down a coronavirus related distribution up to $100,000. And the 10% additional penalty that usually would occur if someone takes on an early distribution does not apply. He can include the income over the following 3 years ratably, and he can recontribute this amount back into his qualified plan, and it will be considered a rollover. And so this actually presents a little bit of a planning opportunity here, in that he can take down an amount as a coronavirus related distribution. He can include this amount ratably over the following 3 years in his income. And then in year 3, he can or before that, he can recontribute this amount back into his IRA, or excuse me, into his qualified plan. And that would be considered a rollover. And he can actually go back and amend his past tax returns to claim a refund on the taxes that he would have paid attributable to that coronavirus related distribution.
Oh, walk me through this again. So you're saying he's okay. So you're basically saying he's going to amend the returns in the last 3 years to get a deduction for an amount he contributes in year 4?
No. So if today he took a $9,000 coronavirus related, or not today, last year took a $9,000 coronavirus related distribution, he can include $3,000 each year for years 1 through 3.
Yeah.
In year 3, he can repay the entire $9,000 back, and then go and amend tax returns years 1 through 3 or 1 through 2, and claim as a refund those taxes that he paid attributable to years 1 and 2, because those were included in income.
That's time.
Okay. Thanks, William. Okay, thank you very much. Appreciate that.